Good morning, my name's Michael Pate. I'm standing in for Paul Kavanagh on Monday the 18th of August for this morning's podcast. So looking at the week ahead, this week we've got results from BHP, Glencore, so two major miners reporting. We've also had Bovis this morning, which produced some pretty good results. They've upped their dividend. We've got Persimmon tomorrow. On the macro front, we've got the minutes from the Bank of England. We've got the Fed minutes, both on Wednesday. We've got some important PMI data from China and Europe on Thursday, and then we've got two speeches from the Fed and Mario Draghi on Friday. So just looking at last week, what made the difference last week, and the key market mover was the Bank of England quarterly inflation report. It was actually a gift for the equity market. So Mark Carney maintained that economic momentum is more assured. Interest rate rises will be gradual and limited. Interest rates are likely to be lower than yesteryear. All very good things for interest rate sensitive stocks in the market, which we'll go on to look at. He also said that wage growth was weaker than expected. This is a key element of inflation and therefore a key element on expectations for interest rates. So through this speech in the week, we saw that LIBOR, that's the 3-month interest rate, fell on that announcement, as you can see there. That's the futures. So we've retraced that sort of rise that we saw back at the back end of June, and we're back to those levels that we saw throughout the year. Equally, the 2-year gilt fell on that news. So as a result, we've seen the FTSE 250 start to make up some of the lost ground year to date against the FTSE 100. The FTSE 100 has been a better performer because the less interest rate sensitive stocks in that index. And as you can see, FTSE 250 has been pretty strong since certainly last week. Within that, we see the interest rate sensitive sectors that picked up last week. Here's the list of the most interest rate sensitive sectors, and as you can see, again, we saw retailers come off the bottom, travel and leisure, support services, we've got the estate agents in there, and the banks. They've all been pretty strong since the second half of August. Equally, we've seen some very weak stocks in this part of the market, so Thomas Cook, Regis, EasyJet, all here. I mean, year to date, these things are down sort of 35%, 35% there. But we've seen a decent pick-up off the bottom, particularly in Thomas Cook. So if you did want to play this sort of rebound in the 250 and interest rate sensitive stocks, we'd be recommending Travis Perkins, Barclay Group and Breedon Aggregates. Barclay Group particularly on the back of those Bovis numbers this week, today. So looking ahead for the week ahead, the key macro data that we're going to see, it's going to be a very central bank-led week in terms of data and news flow. And we expect Janet Yellen's speech on Friday, which will probably be the most important announcement this week, to be pretty pro-market. So as we can see in terms of where they feel interest rates are going, their plot for when interest rates will first rise in the US is pretty much where the market is expecting it to be, so they don't need to pull back expectations for the market. So we don't see a hawkish announcement there. And as you know, Janet Yellen is a labour market economist. So we expect her to really focus on the structural problems that they're seeing in the labour market. And that sort of centres on, firstly, the participation rate in the US labour market, which is very low. A lot of people have become disengaged and fallen out of the labour market, not actively seeking jobs. And also the very high and persistent level of part-time work, those people who are working part-time but would like to be in full-time labour. So both of these sort of issues, this sort of slack represents important slack in the economy to suggest that wages won't be going up rapidly anytime soon, and therefore interest rates can remain at these lower levels to promote growth. So looking at the picture on earnings, the corporate sector continues to look very positive and confident. Here we can see the second half of this year, you've seen a real acceleration in the confidence indicators, the ISM, for the corporate sector in the US. Equally, the confidence board, so this is consumer confidence in the US, that's really picking up, and you look at the key expectations part of that index, which is the forward-looking part of that index, and you know, expectations of improving consumer confidence remain very strong. So therefore, looking at markets and the relative value that equity markets are offering, we feel it's a fairly reasonable proposition to say that we think earnings growth will continue to come through this year. And we also feel that bond yields will probably stay low and lower for longer. So as a result, you've got a very large differential between the earnings yield and the equity market and the yield you're getting in the bond market, the bond yield. So as you can see here, this is the equity risk premium, so the premium you're getting paid over the risk-free rate for owning shares. And this has really sort of taken off over the last year and a half. And at where we sit at the moment, we see the equity market providing pretty compelling value against the bond market. So despite this, despite benign inflation, interest rates, accelerating earnings growth, the market remains pretty nervous. So as you can see here, the relative strength index for the European markets is pretty much down at sort of lows. And that's a reflection of ongoing poor data in Europe in terms of economic data, and we're going to get some more PMI data this week, so we'll get a further read on that. But also, obviously, what's going on in Ukraine is having quite a big effect on confidence within that market. And so you're seeing with the put to call ratio, which is a reading we look at just to see what sort of insurance people in the market are buying, it's pretty high. So there's a lot of bearish positioning. So ongoing concern in Ukraine impacting market sentiment. As you can see here, Russia's actually off its lows. So a lot of the very bad news seems to have been priced in. And what's quite surprising is that the oil price has actually been pretty weak since June, which given what's going on in the Middle East and Ukraine is slightly surprising. And that's the key thing that we'll be looking at, because that's the tax on developed market growth if the oil price starts to go up in response to these political or geopolitical uncertainties. So just looking at Ukraine, clearly on Friday we've got a sort of escalation which has sort of pulled back over the weekend. Just looking at stocks that are particularly exposed to Russia in the European market. Surprisingly, Adidas has got a very big exposure to Russia with 15% of its EBIT. Even more than, in a sense, even more than BP in terms of sensitivity of earnings. Clearly you've got BP with a big NAV chunk in Russia, BASF, Unilever, SAP, and Amadeus actually got 3% of its revenue. So they're all stocks that we like at Killik and ways to play a stronger Russia or de-escalation of that particular Ukrainian situation. Just where we are in the market, our year-end target is 7,400. We're holding to that. Just to give you a sense of how we come to that number, 7,400 is assuming 8% earnings growth in 2015 on a P of 14. If you look at the sensitivity of the FTSE to the earnings and the rating of the market, if we saw earnings growth expand to 15% and you saw a P expansion as well, then you're getting a sort of 8,800 level on the market. We're not suggesting we're going there anytime soon. But equally, if you saw earnings growth actually come in at 0, which would be a negative surprise, and people get more worried about the price of oil going up or interest rates going up faster than expected, and a PE contraction, then we're looking at a downside of around 12% at 5.9. So we're still sticking with 7.4 and reasonably confident about that going into the end of the year. Thanks very much.